The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody. Ladies and gentlemen, hello and welcome here to us at Nadex. My name is Philip, and I will be your presenter for today's webinar. And I would like to start with a very heartfelt big sorry. We had some technical issues to kick off the session, so happy to just made it in time. And yeah, let's just get started. Let's hope that those technical difficulties won't come back and that we will be able to enjoy our session. If you have a look at your webinar interface, you can see that small questions box, and please, by all means, if something is not clear, ask questions. Right now, I would appreciate a very short yes or why in that box to just let me know that both the audio and the screencast are working properly. Perfect. Thank you very much, everybody. Really appreciate it. And let's just quickly change the slides so that you guys can see that the slides are actually changing. Yeah, if something is not clear, I want you guys to learn something. It's not about giving you guys fish, handing out fish and telling you what to do. We will never do that. It's really just for educational purpose. We want you guys to learn something, and therefore, please ask questions. That's what we're here for. You're not interrupting my flow. And I think, yeah, asking questions really is the proper way to learn something and to get started with all this. Today's session is scheduled to run for around about 1 hour, so we have quite a bit of time on our hands to yeah, learn something together and have a look at the markets together. But of course, before we get started, there are our usual risk disclaimers that I need to make you aware of. So please take a moment of your time to read through those carefully and make sure that you are okay with them. Essentially, this says that trading, of course, involves risk and that you should understand those risks and understand the instruments and the risk profile of those instruments before you are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of today's webinar. I want you guys to understand what I'm seeing on those charts, the way that I'm analyzing those markets, and how I like to transfer that into potential trading opportunities here using Nadex contracts. But that's just me. That's just my view on the markets. I don't have a crystal ball. I have a fair share of losing trades, but that's okay, because in the end, trading is about coming out ahead in the end. And this in the end means over a large sample set of trades. So please understand, it's never about one single trade. You never know if that next trade is going to work out or not. And for that reason, you want to make sure that your risk exposure on all trades is comparable. And in the end, you have to own those trades. It's your money you're putting on the line. You must perfectly understand why you initiate that trade. And just because some dude on the internet told you to buy or sell, that should never be good enough for a reason. You must own that trade. So again, it's just for educational purpose. That being said, let's have a look at the Nadex risk warning 2. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes including Forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's have a look at today's agenda. Today we want to focus on spreads. You know that you can trade binaries here at Nadex and you can also trade spreads. Spreads, at least some people think of them as a little bit more advanced than just trading binaries. But once you understand what spreads actually are and how they work and what is the key component that you have to pay attention to, I think they are really straightforward as an investment instrument and I really like to use them myself. So what are the benefits of trading spreads? And the major part of today's session will be done on the charts. We want to look at the markets together and understand how we can build a case for potential trading decision. But once again, this is just an example. Personally, I feel the setup that I'm going to share there with you isn't good enough. I wouldn't take that trade in my own account. It's just to illustrate why something might be there, what it is that I don't like, but then most of all, what is the transfer? How can we put those Nadex spreads into action? That's the key part. What are we looking for and how can we actually apply that knowledge? So that being said, let's have a look at the introduction to trading spreads. What are spreads? Spreads are a simple derivative with built-in floor and ceiling levels. Those of you who know about conventional options, essentially those spreads could be thought of as call spreads. The levels that are being defined by those two strikes of those calls, price varies. The price of that spread varies within that floor and that ceiling level. So those levels define the lowest and highest points at which it can settle. Within that range, price moves along with the price of the underlying market. It's not a one-to-one relationship. Please understand that. Why is that the case? Why is price not really going one-to-one? Well, why is the price of the spread not adapting one-to-one when the underlying market moves? We would have to dive deeper here and look into the Greeks, to look into delta. We are very close because we are usually there in the money, at least for the lower call. This means price will have, or that spread will have a delta which is not exactly 1. We have to make sure to understand this. This is not some kind of unfair pricing mechanism or something like that. It's just in the nature of those contracts and how those contracts have been modeled. Within that range, the spread participates of price movement of the underlying. And the more time value goes out of that spread, the more we approach expiry, the closer price actually will be to where the underlying market is trading at that point. The good news is that if price moves higher than the ceiling or drops below the floor level, our price movement for that spread stops there. So it doesn't matter if that market is going to the moon or is dropping to 0. Your participation of price movement in the underlying is limited to the floor and to the ceiling level. And just because we know that, we can clearly define our risk. And this is true also for binaries and for those spreads here. We always know exactly how much money we can lose if we put on a trade. I will show you this in just a few moments. On the trade ticket, once you open that position, you see immediately how much money can you lose. And if all the stars align, how much money could you potentially make? But as a trader, I have learned to focus on my risk. I must understand my risk exposure. I must make sure that the next trade is not going to kill me. I don't know if the next trade is going to be a winner or not. And if it is a potentially profitable trade, nice. If it isn't, okay, I can still come back and trade and try again tomorrow. I must make sure that my risk exposure is comparable across those trades. If we're looking again at spreads, price movement of the spread is of course based on price movement of the underlying market. This could be a commodity. Today we want to have a look at Forex. Could also be index futures, as we said in the introduction, or cryptocurrencies. It doesn't really matter. It's a derivative. We have always an underlying market, and we want to see and understand and analyze price movement and charts of that underlying market. I'm not analyzing the charts of the spread. I'm analyzing the chart of the underlying market. The benefits of trading spreads are that they are suitable for retail traders looking for leverage and hedging opportunities. Very, very powerful feature now. You can trade with strictly limited risk. You know your risk up front. And this is why it becomes so easy to adhere to your risk management plan. 85% of all people, most people, let's put it that way, most people like to think that the trading strategy, the way to read the charts, That's the most important thing that you have to have in your mind and to get right in order to be a successful trader. Guess what? That's not the case. Strategy is important, but even more important is to have the proper trading mindset and proper risk management in place. Why mindset? Because mindset allows you to understand that even if you lost now 7 trades in a row, while that is not nice, it's part of the game. Trading is all about probabilities. Trading is very statistical in nature. And for that reason, just because you lost money does not mean that you performed your trade in a bad way. You could have performed your analysis perfectly. Everything was really perfect to the letter. And however, you still lost money. This is completely different to any other profession. All our careers so far, how we have been raised, how we have been educated, how we have been trained. You had always the result of your actions, and the result immediately showed how well you performed your tasks. With trading, that's not the case. With trading, you are detached. Right? You're detaching yourself from the result. Because I can do my job perfectly and I can still lose money. In the short run, in the long run, my system will kick in. My system, that edge of that system, which I have verified both in my trading and during my backtests, that system will start to show itself, which means over a large sample set of trades, I should be able to win more trades. I should have potentially more profitable trades on my hands than losing trades. And if I do my risk management correctly, my trade management correctly, I should also be able to have larger winners on my hand. I could make more money potentially on those profitable trades than the money that I will lose on my losing trades. And there will be losing trades. You have just to accept it. And therefore, if I don't know if that trade is a winner or not, my risk must be the same. It doesn't make sense to bet the farm if I don't know and can't know the outcome of the next trade. Same risk exposure across all trades. Very, very easy here with those Nadex instruments. Just like any other leveraged products, you have very low collateral requirements in order to initiate that position. Take highly leveraged positions if it suits your risk profile, and you have different expiry cycles here, also geared towards or aimed towards the short-term trader. You have multiple daily trading opportunities setting up here. So without much further ado, let's just have a look at the charts together. And there are my charts. I'd like to kick it off today. And main focus for today would be Euro against the British Pound. I'm looking here at a daily chart. What is it that we can see on that daily chart here? I always want to build a case. I want to have a strategy. I want to have a plan. I want to have a recipe. Because this recipe allows me, what's very important, it's consistency with my approach. That law of big number, the advantage of my trading strategy that I mentioned, can only manifest itself if I have that proper trading strategy in place and I follow my set of rules to the letter. This is the only thing that I can make sure that I adhere to my rules. This is the only thing that I can control. I can't control the outcome of the trade. There's Mr. Market. The outcome of any one trade is random, but if I follow my rules, the law of big numbers will kick in and the edge of my system should start to manifest itself. How am I approaching the market? I'm not just jumping in. I'm not just gambling, rolling a dice. I want to have an idea. How do I get this idea? Well, I look at a chart. And on that chart, I try to identify many small advantages. It's not about that one big setup. It's gathering many small favors, many small advantages. And if you start to stack those advantages in your favor and try to build yourself that case, then suddenly you will start to see that the outcome of one trade is still random, but over a large sample set of trades, I'm winning about 60 out of 100 trades, or maybe even 65 out of 100 trades, and that's enough. You don't have to win all of your trades. You can't win all of your trades. You should aim for having more potentially profitable trades on your hands than losing trades. And if those potentially profitable trades are also larger winners, That's the edge that you're looking for, and that's good enough. That's absolutely good enough. Don't burden yourself with that idea. Every shot must be in the center. Every shot must be a bullseye. Every trade must be a winning trade. It doesn't work like that. So what am I seeing here on that daily chart of euro against the British pound? I see that this market here pretty much is in a range-bound market. Usually I'm looking for good trading opportunities in an uptrend or a downtrend. Why? Because if I think that something is in motion, it tends to stay in motion. Just like the Newton's laws of physics, unless an opposing force is applied, things tend to stay in the way that they are. So if price is going higher, decent chance that price will be going higher. So I think there's a decent chance here that price might be staying in that range. However, we can see that price has been gathering some kind of momentum here. How can I see that momentum building up? Well, my moving averages here have started to fan. We're looking here at a 10, a 20, a 50, and a 200 period moving average. And the idea is that if that market is going sideways, you have that reaction like here. Those moving averages pretty much are all over the place. Same thing is here. I can't really tell you guys here if the 10 is above the 20 or the 50 or just the other way around. But once price starts to move into a certain direction, you start to note that those moving averages start to spread out. Just look at that phase that we saw here. Clearly the 10 is above the 20, the 50, the 200. I only get this kind of pattern, that structure of those moving averages, once price has been trending for a while and is building momentum here. And the idea here is that price might be starting to gain some momentum here. However, the idea is always, well, we are in that range, and as we have identified this level, market participants have reacted to this level here in the past. The most precise reactions have occurred here and there. This one here was a close encounter. That one wasn't that good after all, but this one and those ones here and the third one, that level has some kind of significance. Easy set of rules for those levels. You just pick those levels, you put them on your chart, and you just try to see where they stick. Not a precise science, you just move them around and start to see, all right, where is something happening? Where do I get a lot of different touches of those levels here? Something like that. That's good enough. The more touches we can now see, the more precise price points where price turned around and reacted to this level, the more significant that level will become, or that level already is. Why? Why do charts actually work? Well, this is not just price. Yes, sure, the chart shows price, but price is the result of the behavior of market participants. And if people thought that at that price level here, maybe price is too high now, and you had a sinking volume in the market, you felt that less people found it, let's put it like that. Less people thought that it was a good idea to trade at those price levels, and therefore price started to come down again. What I'm seeing here is some kind of resistance, some kind of mental barrier, if you want to put it like that, of market participants. Here people thought, well, this is a good support level, I buy this market. I think the buyers thought at that price level it's cheap. Their price went higher. Price came back, remained there for a little while, and then started to go lower again. Now here that level was acting as support. Now this level is acting as resistance. The idea here is that if price starts to push higher, if people trade it around this level quite frequently and heavily, the idea is that they might do so again here in the future. So what am I seeing here? Price is starting to push higher. I have some larger green candles. The moving averages also suggest that we see some kind of momentum building up here. I have convergence here in my indicators. What does convergence mean? If price is making a new higher high, what we have here, MACD is also making a new higher high compared to the previous one, and RSI is also making a new higher high compared to the previous one. this is usually a sign of strength. If that was not the case, this would be some kind of early warning sign. An idea that something was not quite right and price would probably not be continuing in that direction. However, here, right now, I see, momentum building up. I see higher highs and higher lows. Within that overall range-bound market, I'm starting to note a small uptrend. That's the daily chart. I don't want to trade that daily chart, but if that daily chart is now giving me this idea that this market might be going higher, at least over the next 1, 2, 3 bars maybe, I can start now to drop down with my time frames. And you start to see that what was really just 1 bar here or a few bars on the 8-hour chart looks much more pronounced, and the structure becomes much clearer here. What do we see here? It's an uptrend. We see higher highs and higher lows, and we start to get those pullbacks. We get a pullback here into a moving average buy zone. Was it a setup here that was tradable? No, it wasn't. I would have preferred to see a small bullish candle setting up here, but the overall trend structure starts to appear here. Notice, please, once again, the fanning pattern in those moving averages, strength building up while this market has been going higher here. You see also that MACD and RSI looking pretty strong. The 8-hour chart is also showing us that this market is going higher here. Let's have a look at the 4-hour chart. Pretty much that same idea, that same story. Higher highs, higher lows. We get a pullback here in our moving average buy zone. Price is pushing higher or starts to push higher again. Why is it the moving average buy zone? Or in a downtrend, why is it the moving average sell zone? The idea is that price is mean reverting, which means that if price has pushed too far away from its mean, from its average, it starts, we like to call it, it becomes overextended. The idea is that price will start to come back. If it has moved too far, too fast, it will be exhausted. And for that reason, it has to rest. It will have to come back to those price equilibrium, to those resting levels. And as it's mean reverting, we are using a moving average, a moving mean to help us identify those levels. We're looking here at the 10 and 20, and we have found in our research that price tends to pull back to those levels. And once it's there, we are waiting for reversal candles, reversal patterns setting up, and then we think that pullback is over and price might start to push higher. We start to see that behavior here on the 4-hour chart. Let's have a look at the 2-hour chart. Pretty much that same idea happening here right now. Let's drop even further down to a 1-hour chart. And the thing that I saw when I prepared for today's session here was that I am looking now, I'm starting to see some kind of flat level setting up here in this area. We have 2 core strategies that you can also learn here about in our advanced webinars. One is the trend flow strategy. This is this move higher, pull back here towards our moving average buy zone, and then the trend continuation. The next one is the momentum breakout strategy. The momentum breakout strategy is a setup where you say, I'm in the context of an uptrend. Price has been pushing lower, retracing, and now it's starting to build a flat level. I start to see the price really wants to go higher here. I can see the pullback and now, but the big picture here is still this uptrend that I'm looking at. Now price starts to build up momentum again. Deep pullback, a little bit too deep, but it's okay. Then next run higher, and we are testing this level. We can see the level worked here and there, and now here once again, and price is pulling back again. Market participants are reacting to this price level. They think, a little bit too far, too fast, let's start to sell this market. But guess what? Buyers have been coming back earlier. They didn't wait now for price to retrace to this level. They were eager to buy that market. They became more aggressive. Buyers stepped in at those levels here. And sure enough, we went for another test of this level. And now we started to see the breakout of this level. And that was the setup that I was looking at. And the question is now, how, once I identified this level here, how could this become potentially tradable with Nadex contracts, especially with spreads here? Are there any questions so far, considering the chart setup, the way that I'm looking at those charts, about the indicators that I used, or my whole reasoning on how I built that case that might have been here a potential trading opportunity just setting up? If there are any questions, please don't be shy. That's what we're here for. And I'm pretty sure that there are no dumb questions, and I hope my answers won't be dumb as well. So by all means, ask questions. Jason, thank you very much. Really appreciate that. All right, good. So the idea is I want to be long. For this educational purpose, the idea might be that I could consider being long that market. Keep in mind, it's not a trade recommendation. And yeah, let's just jump over here to the Nadex platform. Now, the question is, and I'm looking here once again at, let's close those down. I'm looking at Forex spreads, and I'm looking at Euro, British Pound, and I'm looking at the daily spreads. Now, what is a potential spread that I could consider trading here? First thing is I'm looking at the daily spreads. Why? Because that spread has about 2 hours and 33 minutes left. This webinar is located at a little bit tight spot because most of those options which expire in the morning hours pretty much have expired the moment this webinar is supposed to launch. And for that reason, I'm usually limited here on those daily contracts. While they might not be the perfect sweet spot, I hope they are fine to just illustrate the idea and the purpose. Now let's do it like that. We're looking here at those spreads. 2 hours, 32 minutes left, and this means I'm looking here currently at about 2.5 more candles. So this candle, the red one, which is currently red, can still finish. And I will get 2 more candles and then this contract expires. I don't have to wait for my position or for that contract to expire to close my position. Nadex contracts, spreads, binaries are completely tradable instruments. It's not fire and forget or hope and pray. You open that trade, you can put in market orders to close that position, you can put on limit orders to close that position, you can actively manage your position, which is a really, really huge advantage. So keep that in mind. Price is going higher, price is not pulling back. And guys, by the way, just coming back to the chart, that's a pattern that is also quite common. You see that level, you're waiting for the breakout. I just mentioned before that a level that has worked as resistance so far usually is then becoming support, and the other way around. And this is pretty much what we are observing here right away. Let's move this over once again and just drop down a little bit further here with our time frames. Guess what's happening here now? We have broken out of this level. We get a small reversal candle. We are now pulling back. Where does this pullback lead us to? Well, once again, it leads us here on the 30-minute chart to our price equilibrium levels, sitting right here then on top of the moving average buy zone and on top of this level. This could be considered a follow-up trading opportunity. Again, it's just educational here. If you don't think that that's the trade, you have to own your trade. It's never a recommendation, just to be sure about that. We get the breakout and now we're pulling back, and the idea is that we might get a small bullish candle setting up just on top of this level, because this level is now supposed to work as support. And if it is working that way, that's usually the breakout and then the follow-up trading opportunity just setting up here on top of the level, making use of that level to maybe even protect our stop loss location if we were to use stop losses. You don't have to do, and you don't have to use stop losses with Nadex contracts because you know your risk up front. More about risk in just a few moments. So let's come back here to our contracts. Which of those contracts could I consider trading right now? Which of those contracts would make sense? You always have a floor level of those spreads and you have a ceiling level. For example, this contract here would float here now in a range of 0.8660 to 0.9160. Let's just keep that in mind. And why not put in here, let's just do it like that, and why not put in here those levels on the chart, and let's just change the colors here to make sure that we don't confuse those levels with our technical analysis. So the first level that we're looking at would be the floor level of 8660, and let's just enter that number here, 8660. You see that one isn't even on the chart here. Where is it? This is the floor level of that first spread that we just had seen here. Where is the ceiling level? 9160. So let's punch that number in as well. 9160. Okay, so that's the complete range in which this contract would move along. We're sitting right in the middle here. Is this the most perfect contract to trade? I don't think so. Let's just assume we are bullish that market and we would consider trading one contract here. So I'm just clicking on the offer here and looking into trading one contract. Guess what? Just trading one contract, my maximum loss would be $273. My maximum profit just below that, 227. So my reward to risk ratio on that trade is definitely smaller than 1-to-1. Why is that the case? Well, I have my floor level here, my ceiling level here. Within that complete range, price of that spread will participate with what the market has been doing here. So if price starts to drop all this way down here, I'm part of that ride, which is why my potential loss is about $270 per contract. However, I have also this upside potential in that trade. However, I really like to have a very nice and decent reward to risk ratio. This contract really doesn't qualify for that. The idea is that if I want to enter a trade here, if I want to be long a market, I'm usually looking for a contract where I can enter very, very close to the floor level. Why? Let's have a look at a different one. We are now looking here maybe at this 8910 to 9160. 9160, we already have that on our chart. 8910. So we're looking here at 8, 9, 10. Well, where are we sitting right now? And I have to zoom out here or zoom in again to just make sure that we can see all that goodness. All right, here we are. And by the way, you guys can start to see that. All right, like that. You guys can start to see that this level maybe is already acting here as support. We start to get a small bullish candle sitting right on top of that. If I trade based on those candles, I always wait for those candles to finish printing. This candle here can still go on this half-hour chart for 26 more minutes. I have seen the structure of those candles change dramatically within the last 10 seconds of that candle still being active. Always wait for those candles to finish. But that's not the case here. This is just a quick reminder. Why could this be here a much more powerful setup to trade or more powerful contract to choose? Well, if price starts to drop, how far will we participate with that drop in our potential long setup? Well, just until we hit our floor level here. However, if this market decides to go to the moon and beyond, this is where the ceiling is. Now, entering from this price level down here, short distance, huge distance here to the upside. This is our risk, and that's our potential reward. That potential reward is so much larger here than the risk, that I much more prefer that trade here, or that spread, that floor ceiling combination to the other one, because here my downside is just limited. Let's have a look here at this contract. It's the top one here, and let's just do the same exercise. We're looking into potentially buying one contract here. Now, what's my maximum loss now on one contract? It's just 26 bucks. Why? Because we are so close to the floor. My maximum profit, however, is $224 per contract. Why? Because the ceiling is so far away. One important distinction here. With binaries, you always have that outcome 0 or 100. Therefore, the name binaries. With a spread, it's really how deep or how much will price actually push in that direction at expiry that determines the outcome. So it's not we are trading above our entry price and therefore this is my guaranteed profit. Profits are all, first of all, trading is risky and profits are never guaranteed. However, what does have to happen for that maximum profit to manifest itself? Price will have to close here at this level or above within the next 2 hours and 23 minutes. Do you think that this is likely based on what has been going on here in the past? I don't think so. However, my downside is limited. My downside pretty much, or the floor level is sitting pretty much also on the chart in a quite nice sweet spot where I say, yeah, that makes sense for me. I can work with that. And for a 1-to-1 reward to risk ratio on that trade, how far will price have to travel? Well, the same distance that we have here between our entry and our ceiling floor level, pretty much here 1 to the top. So something around here, 89,507, somewhat in this area. Do I think that this is likely to happen within, or is this possible to happen within the next 2 hours and 22 minutes? Yes, I think something like that is achievable. It's not a forecast, it's just what was the speed of the market before, or what has been the speed of the market, what's the volatility of this market, and do I think that it's likely that we will see now large candles hitting this level? No, I don't think it is. However, do I think it's likely that this market might be going higher and still give me a decent reward to risk ratio? Absolutely. So, how could we approach this? Let's do a quick timeout for 1 second here. Do you guys have any questions on why that second contract that I showed you, at least in my eyes, does give us a more favorable risk profile, reward to risk ratio than the first contract that we looked at? This contract and instrument selection really is a important and crucial topic when it comes to picking those contracts. With ceilings, with spreads, you have those floor and ceiling levels, and there you have to, the rule of thumb is if I want to be long that market, I try to enter as close to the floor as possible, because then I can't fall pretty much lower, but I have all the upside to the ceiling. And if I want to be short a market, just the same logic applied, I want to enter a short position as close to the ceiling as possible, because if this market starts to rise, it's going against me. I'm already sitting at the ceiling. I can't go much higher than that. Therefore, my loss should also be limited. However, if this market decides to fall, I have a lot of room to participate in that move. So if there are no questions, I would like to turn my attention now to risk management and proper position sizing. How do I proper position size that trade? First thing to notice, I'm using a demo account here, and within that demo account, I have around about $24,000 left. Of those $24,000, I'm willing and I'm happy, and this is the same thing that I do with my own trading account. And it's not just me, but pretty much every professional trader that I've read about, that I've talked with, that I know of, we all agree pretty much that risking about 1% of our account on any one given trade is or seems to be some kind of accepted sweet spot. So if I have those virtual $24,000, what is 1% of $24,000? It's $240. My idea is, if this trade is not working out, if everything goes wrong, it's okay for me to say, okay, I just lost $240. Does this kill me? No. Is still enough money left that I can place my next trade and the next one after that? Sure, absolutely no problem at all. That's the main idea. You want to be able to stay in the game. Trading is not about hitting that home run, becoming rich overnight, and that's it. It doesn't work like that. Sure, there are stories like that. It can be done, but the risk that you have to take is just so huge. You must make sure that you can still trade again tomorrow, and risking 1% per trade is a decent way to get started on that road. We would have to talk about market correlations and all those things as well, but looking at just one market, one trade, I'm willing to risk 1%. So $250 to risk. How many contracts could I trade now here with that setup? Well, trading one contract at the current price, I'm looking at risking $26. And that's the great thing about Nadex. I know my maximum loss on that one contract here is $26. It doesn't matter what happens in politics, in national politics, in military disputes, in wars, in oil wells blowing up, and so on. No matter what happens, I can't lose more than $26 on that one contract here. This is very, very powerful. This is quite unique if you compare it to, for example, futures trading or selling naked options in conventional markets. Now, I still haven't answered that question. How many contracts can I trade? Well, Nadex makes it very easy. I want to risk $240, so I just start to increase my position size here, and you see that number just goes up. And I'm happy to initiate that position here in this example, and once again, it's a virtual example. If I was to trade 9 contracts here at this price level, I would be risking $234. If everything works like a charm, and yeah, once again, working like a charm means price settles here, I could be making $2,000 on that risk of 234. Won't happen. Never say never, but the probability for that happening is very, very small. Do I see a decent probability of at least hitting a 1-to-1 profit target, or maybe even 2-to-1? Yes, that might happen. So that's the basic idea here on how you approach your position sizing. How much money do you have in your account? Risking 1% of that, how many contracts can I trade in order to make my maximum loss about 1% of my money? Jason is asking a great question, how you can learn more about the Greeks. Can you recommend a few resources to help us learn more about the Greeks? I'm quite honest. The way that I learned about the Greeks was through literature, and I think the book that I used was Macmillan on Options. It's been quite a while, and I learned about that stuff also at university, but I think the big introduction for me was that book Macmillan on Options. Was it a brilliant book? I don't think so. It got me started with the subject, it got me started to think about all this stuff, but hey, we're now living in the internet age, aren't we? For that reason, why not have a look around Investopedia, for example? Just fire up good old Google and see what Google will give you. Google Introduction to Greeks. And I think those Investopedia articles usually are pretty decent and spot on. So that would be my first suggestion and starting point. I'm still thinking if I had any really, really good book that just made things so simple and easy, but I can't think of any other. The idea for me would be, if I want to learn more about the Greeks, I would start with Delta. Delta is, I think, quite easy to understand and really drives the point home. Next thing to focus on, very important, is theta, making sure to understand how time expiry or how time passing influences the value of your option. And the next one would be thinking about volatility. Now, if we have a look at those Nadex instruments here, I think really the most crucial one that we want to understand is really delta. Those options here usually have a very fast expiry time. They don't live very long. For that reason, I think theta and vega don't play that much of a role. Therefore, thinking about delta and then in the next step, gamma probably should do the trick for you. Jason is also asking about the charting platform. This here now is TradingView. It's not a recommendation. You have to find a platform that you like where you can put on those analysis and markets that you like to do. I think the Nadex charts are fine for just getting started. In the end, you have just very few tools to analyze or to perform your business as a trader. One of those is the charting platform, and there is no right or wrong answer. Everybody is looking for his perfect charting platform and tool, and I think TradingView is doing quite a nice job at giving me the charting functionality that I'm looking for in an easy to access format. There are a ton of different software solutions, web-based platforms, and so on out there. You try them and you pick what you like best. All right, I think that's it for the questions here so far. Any questions from you guys here considering risk management, proper position sizing? First step was I want to understand why I want to trade that market. Once I thought that's a good market to trade, next step was, okay, which instruments could I be using in order to implement my strategy? First, the picture that I'm using for this is always, first I want to know that I want to go from Chicago to Manhattan. And once I know that I want to travel there, then I will have to think about how do I want to get there. Will I fly in? Will I go by train? Will I go by Greyhound? Will I go by car? Will I ride my bicycle? That's the way to implement that strategy. But the strategy, the setup is I want to go from point A to point B. And if I'm using then a binary or a spread or anything else, it really comes down to what the setup actually is and how I want to implement that strategy. So it's not that spreads are better than binaries. Both are very powerful tools. And I hope you can see that especially this handling of the floor and ceiling levels really is giving you guys a lot of opportunity to tweak your reward to risk ratio, for example, and really work that risk profile of those trades. I'm not placing the order right now because I placed that order just a little bit before I kicked off that session. You see back at that point in time I was able to trade 10 contracts. That position went up to a profit and loss of about $100 here at that point. We're now pulling back. 2 hours and 11 minutes left. I think we're pulling back here now. We might be seeing a potential reversal candle, and I think we still have a decent chance the price will still go higher over those next. We're looking at a half-hour chart here, half an hour, which means we have about 4 more candles. This candle can finish printing and we have 4 more candles to form until that contract expires. So that's the idea. What I found to be really helpful when looking and analyzing those spreads is to really put those levels of those floors and ceilings onto that chart. Because you think, yeah, I'm sitting somewhere in the middle, and suddenly you realize, wait a minute, that's so far away, and or my floor level is so close. Just makes perfect sense to have them on your chart and just give you that visual level of confirmation also where your spread actually is located. I found it quite helpful for me, to be honest. All right, so that was the idea here with euro against the British pound. Let's have also, all right guys, you want to talk more about spreads? Or I have still one more example about a potential setup that I saw yesterday evening in the market and which I didn't like and didn't take. and I can explain the reasons why I didn't take it. And just a few minutes ago, I saw that I was spot on with not taking that trade. And I'm more than happy to also share that kind of chart reading and analysis with you. So you guys tell me if you have any questions right now on the spreads, on instrument selection, if you want to analyze any other markets, or if I should be talking about the about that potential setup in Aussie against the Japanese yen that I saw yesterday. Ernest is asking another good question. What's the ideal time frame chart? It doesn't matter. Sure, those Nadex contracts tend to be available more on the shorter time frames. So looking at hourly charts, half an hour charts, stuff like that is okay. For some contracts, you also have weekly cycles. So looking at a daily chart would be convenient there. We always like to tell you guys that trading is a lifestyle choice. And this means you decide how you want to trade in the first place. You must understand when you have time for your trading. Usually, you're not full-time traders. You have your normal job, you have other obligations, you have your family, you have things going on, you have life happening. If you now try to squeeze trading in somehow, and you have other opposing forces and people trying to pull at you and say, no, you can't be trading right now. If you want to trade from your office and your boss is looking over your shoulder, probably not the happy place to be in to properly analyze the markets and place those trades. If your husband or your wife is telling you, why aren't you there here at dinner table, probably also not that stress-free environment to make proper trading decisions. So the first thing that you have to make sure is to find that time slot that is working for you. And once you have that time slot, then you can decide which markets do I want to trade, and for also which time frames can I be analyzing and looking. And for example, if you think, no, I can only really trade in the evening and nothing wrong, then you focus here on those weekly options and pick those expiry cycles and analyze those markets. First, your lifestyle choice, and Jason is putting it out very nicely. That's one of the reasons why we have a trading plan. You think you must find when you can focus on the markets. It doesn't have to be an awful lot of time, but you want to be consistent. You want to be consistent with your scanning. You want to be consistent with your trading. People always shy away from that idea, I have a routine. Routine sounds dull, sounds boring. Nobody wants to have a routine. I want to quit my 9-to-5 job so I can be a trader, because then I don't have to have a routine. Guess what? I was really struggling with my trading unless I forced myself into a routine until I was until I really understood that routine is giving me a framework, is giving me strength. I don't have to talk to myself all the time and convince me that now would be a good time to have a look at the markets. No, I have my routine. I sit down, I scan the markets, I place my trades, and that's it. I'm not watching those screens all day. Life's far too precious and has far too much to offer to just watch trading screens all the time. I like to focus on higher time frames. I like to pick my battles and then place those trades and be done with it. So that's that one. And the ideal time frame, the time frame that works for you. People think there is that one magic market, there is this one magic time frame. You pick those time frames in those markets and you just make a killing. No. You make a killing once you become the best trader that you can be. And this is part of picking your markets and picking your time frames. I see it with my colleagues all the time. It's not that they are trading 5-minute charts. A few of us do. I'm way too old for that. You focus on what you like best, and there you make the same amount of money potentially than the other guys. It's not that magic thing. Ludmilla is asking about the Aussie against the Japanese yen, and let's have a quick look at that one. I was looking at this market yesterday here on a 4-hour chart. And what I was seeing on this 4-hour chart is a beautiful downtrend. Price is pushing lower all the time. And now prices started to pull back. And prices started to pull back here with a large green candle and then a rather indecisive smallish green candle. And so the idea might be that this candle here, while it was still forming, might be a potential short trading opportunity. In the end, it turned out to be a bullish candle. It wouldn't have been a short trading opportunity, but I was stalking that market and was considering placing a trade here. Stalking is also a very good buzzword here at that stage. I'm not looking at a chart and say, that's the market I want to trade right now. Usually I see something setting up, but I wait for my perfect setup to occur. And that was the idea here. I'm looking for this pullback here, next leg lower, downtrend, pulling back, small bearish candle setting up, and trend continuation. I was stalking that setup. I was waiting for that setup to occur. Didn't happen. Apart from that, I wouldn't have taken that trade anyways. Why? First thing to notice, we are seeing lower lows in price, but however, we start to see higher lows in RSI. This is this bullish divergence setting up that I mentioned before. I'm not getting that same information by looking at the chart, looking at price and looking at my indicators. Something is not quite right here. That's the first thing that really bothered me. Next thing was that pullback here, that candle was rather large and the 10-period moving average already has started to pull back here as well. That's the 4-hour chart. So here, the first two warning signs where I said, no, I don't like that price action. But the big one for me was the daily chart. Because on the daily chart, what we saw there, price was still sitting pretty much here at that level. We are too far away here. First thing, it's a nice downtrend here on the daily chart. Don't get me wrong. So the trend is right. But we are overextended. We have moved too far away from our price equilibrium levels. And this was the thing that really finally killed that setup for me. I thought when I saw that pullback going on, I thought that pullback might be going on for quite some time. Just pulling back here, that's too short. Price hasn't recovered yet. Price hasn't rested yet. There is still so much more. And guess what? Price pulled back towards our moving average sell zone here. And we'll have to wait and see how that continues there. Why did I consider that short trading opportunity? The daily trend is down, the 4-hour trend is down, everything pointed down. However, price overextended on the daily chart. Would I consider a counter trend trade, trading that retracement here on the daily chart? No, because the trend is down. 4-hour chart, pretty much the same thing. But if we drop down here, for example, and have a look at the 1-hour chart, we start to see that we have setting up here some kind of uptrend. If you want to focus on the lower time frames, that could also be building that case. Yes, the 4-hour chart is a downtrend, but it looks like a very weak downtrend with an early idea that this market might be going higher and the trend might be changing on the 4-hour chart. The daily chart still suggests me that this pullback might be going deeper. So why not have a look at those lower time frames, maybe 15 minutes, and try to identify some potential trading opportunities there. That potential trading opportunity might have been, for example, this kind of breakout trade setting up here. Would this have been a valid breakout trade? No, it wouldn't have been, because I get strong divergence here. Would it still have been a successful trade, a winning trade? Yes, it would have been a winning trade, but it would have been a bad trade, because that retracement here, that bearish divergence here in MACD made it rather unlikely. Big no-no if you're following the rules for the momentum breakout trade. That was the idea about that trade and that chart reading from yesterday. And guys, you can combine those different building blocks. There's scanning for convergence, divergence, the moving averages, the buy zone, price equilibrium levels, the candle size. You can arrange those building blocks in pretty much any way that you want to. The only thing is you want to identify things that happen over and over and over again, and which make it a little bit more likely for price to move in a certain way than it won't. And once you start to stack those building blocks on top of each other, this is how you can create your own trading strategy. All right, guys, that's pretty much it for today. I think we covered a lot of ground today. Especially, I like to talk about those spreads. Yeah, thank you very much for tuning in. I hope you liked today's session, you enjoyed today's session. If there's anything that you want to let us know, please feel free to do so here now on the questions box. Sign up for our, sorry, losing my voice. Please sign up as well for our other webinars. Would love to welcome you guys back there again. And yeah, for the next few trading days, I wish you all the best. Happy trading. Yeah, looking forward to seeing you guys again soon. Once again, thank you very much. Happy trading. Take care and bye-bye.